Welcome back to the channel. Tesla is one of the most talked about stock. I believe majority of investors will agree that Tesla is a quality company, given its ability to produce electric vehicles at scale, plus generate huge profits, something which no other EV vehicles have achieved. However, valuation might be that one thing that stops an investor from putting money into Tesla. I'll be doing up two videos on valuations. In this video, we discuss a 10 trillion scenario shared by analyst Pierre Ferragu and on the variables penciled in for a possible 10x increase in stock price by 2030. These are exciting stuff, so please share your comments after checking it out. For those who are new to investing or beginners to valuation models, I'll give a brief overview of a simple valuation model in this video and follow up with a comprehensive sharing in the next part 2 video. So do like this video and subscribe to the channel to be notified of future videos. Please do not treat this as an investment or any form of advice. Always do your own due diligence. For disclosure, I do own Tesla stock and may be biased in my view. I may refer to stock prices in the subsequent slides for sharing purpose. This is not a recommendation to buy or sell, but an educational video on valuation models. One should understand the concepts and build a model using his or her own assumptions before making an independent decision. Pierre Ferragu is a well-known analyst in the Tesla community for his research work. He posted what it takes for Tesla to reach a 10 trillion market capitalization in 2030, which implies a share price of about 10k, assuming share count is about 1 billion. The point here is to show you how industry practitioners look at valuations. These are not rocket science and can be broken down into bite size even for beginners. In this slide, I will drill into the assumptions made by Pierre. Do note that he only shared on the fundamentals and multiple columns. I added the implied share price column derived out of his numbers and assuming share count of 1 billion for easy reference. Also, I do not have access to the actual report and commenting based on personal opinion with no reference to his report. In the table, Tesla is broken down into 5 business verticals. You can see question marks in real world. AI probably is very hard to quantify with the industry at its infancy stage. We are talking about humanoid robots replacing human labor and removing labor as a constraint of economic growth. Elon recently mentioned that this is the focus of Tesla, but it's still hard to imagine and needless to say quantify the value. Hence, we can view it as an optionality. In other words, take it as a bonus if it happens and not factor in the stock price. Everyone knows about Tesla's leading auto position, its potential to disrupt the energy sector, but building a humanoid robot is way larger than the first two sectors. It has such extensive impact on human mankind. If Tesla can execute this, lots of business value will be unlocked, and this is the kind of optionality that a growth investor like myself look for. Putting out such a huge challenge also suggests that Elon may probably continue to run the company for a long time to complete the mission he set out. Okay, enough of the robot hype. Moving back to autos, we zoom in on this business as it is the biggest part of the overall company today. Revenue of 700 billion is penciled in assuming 20 million vehicles and an average selling price of 35k. Tesla sold near to 1 million cars in 2021. And to go to 20 million by 2030 requires a CAGR of 41%. Is this 41% reasonable? Tesla gave a 50% long-term growth guidance in their earnings and is currently growing at 87% year-on-year as of 2021. And we also hear Elon talking about growing 70 to 80% at the Berlin Giga Berlin opening address to staff. From this perspective, 20 million vehicle and 41% CAGR is hard but not impossible in my opinion. As for its average selling price or ASP is currently at about 50k, which is way higher than the assumption of 35k. This means average selling price can be a lever to achieve the 700 billion revenue. If ASP turns out higher than 35k, then Tesla needs to sell lesser number of vehicles than 20 million to get the same revenue. To add on, revenue of 700 billion requires annual growth of 35%, which sounds reasonable to me given the low penetration of electric vehicles at low single digits today. With a multiple of 5, you derive an implied share price of 3,500 just for the auto business. For beginners, this part will be covered comprehensively in the next video. Moving on, if you repeat the same exercise on all of the 4 businesses, you arrive at the last row in red. The combination of fundamentals and multiples generate an implied share price of near to 10k for the whole company, be it using revenue or operating profit. EBIT stands for earnings before interest or tax, or commonly known as operating profits. The assumption is for Tesla to reach an annual revenue of 1 trillion in 2030, mostly from cars at 700 billion and 250 billion from energy. For your information, Elon has mentioned that he sees energy business to be equivalent to the size of the auto business, So this model implies that energy still has leg to grow to match auto. In terms of multiple, a price to sales of 10 is assumed, which is lower than the current 21.5 that Tesla is trading at. Applying a multiple of 10 on 1 trillion revenue, you will get a market cap of 10 trillion. If the stock count is at 1 billion, then implied share price is about 10k. From a current stock price of about 1k, that implies a compound annual growth rate or CAGR of 29%. Or rather, if you invest at 1k, when it moves to 10k, then it will be a 29% CAGR. This does not mean you generate 29% positive returns every year. Your return may fluctuate every year as you move along, but on a long-term basis and on average, the annual return will be about 29%. If all these variables are materialized in 2030, of course. I'm now moving the last two slides on valuation that's meant for beginners. You may choose to drop off here if you're well versed with the topic. Appreciate your time for watching. Thanks for those who stayed on. This and the following slides will be the lead in to my next video. The objective is to share a simple yet in-depth valuation model for beginners. We will do a scaled down model of what you saw just now and one that's easy to understand. The focus will be on scrutinizing the variables to make sure these assumptions do make sense. We will work on what we call a relative valuation model, which means comparing industry peers to guide us on how much price sales multiple to assign for Tesla. Essentially, you can think of a price to sales multiple as how much you're willing to pay for $1 of annual revenue. I've chosen price to sales instead of price to earnings, though Tesla is profitable for simplicity's sake. Revenue is the top line of an income statement and the most easy to understand, whereas earnings have more nuances of what drives the number. Both multiples are actually related and a derivation of each other, but I won't go into details here. There are only 3 variables or what you call assumptions that are needed. Of course, you can go down to very granular details, but more variables may not necessarily lead to a better model, as you will have more moving parts with potential for these numbers to be inaccurate. The point here is to keep it simple for beginners and to drive across the general valuation concepts. You can edit the model once you are comfortable with the topic. The robustness of the variables here are key. In other words, you have to make sure if the assumptions used are reasonable and make sense to you. You will later see that there are lots of work to do just for the 3 variables. Before you dive into valuation, you should have completed an in-depth research of Tesla and conclude that it is a quality company. If Tesla is not a company you're convinced of, it doesn't matter what the valuation is. Will you buy something you don't need or don't like even if it's super cheap? Also, valuation is a range and subjective to each individual, so you need to form your own view. Lastly, valuation model is about probability and one's assumption, which means it may not materialize due to so many unknown factors that may happen in future. Your model may suggest that you enter at an undervalued price now, but the facts may change subsequently, rendering your entry price as overvalued or even a loss position. Nothing is guaranteed in investment. These are key principles that you have to bear in mind. This is how the model will look like. It's very similar to what you saw just now, but we only look at the auto business with only 3 variables that derive the implied share price of 3,500 by 2030. We only look at auto here not just for simplicity, but also the built-in margin of safety. We are someone who recognizes the lead Tesla has achieved in the auto industry today, but yet unsure of the other sectors. Then it's conservative to just price in autos and treat other sectors as optionality or bonus. In the next video, we will dive into this model so keep a lookout for it. I will greatly appreciate if you can like the video and subscribe to the channel. See you in the next video.